In today's video, I want to discuss every stock I own in the YouTube portfolio, why I own it, and what I think about its price today. This is basically going to be like a portfolio update, but also letting you all know what I think about the valuations of every stock within the portfolio and what I would be looking to add today if I had more cash. Now, with that being said, the first thing that I always like to do is simply point out the YouTube portfolio's performance versus the S&P 500. So since the inception of the YouTube portfolio, we can now see that it is up roughly 37%. It is hitting all-time highs right now as well, versus the S&P 500's returns of 21.2% since I started the YouTube portfolio. So this portfolio is still outperforming the S&P 500, and again, the portfolio is hitting all-time highs right now. If we take a look at the diversification, you can see the pie chart right here, and if we hit view all, you can pause the video right here if you like, and this is the portfolio's diversification as of recording. So now let's scroll down and take a look at the 16 different positions one by one. And let's start off with Amazon. I own Amazon for many different reasons, but overall, I think that this company is not going to go anywhere, and I think that it will continue to grow for literally decades to come. I think that this business has such a strong moat that it is not going to be disrupted and probably continue growing its moat, and I want to continue owning it for the long term, probably for the rest of my life, unless something major and dramatic happens to the company's moat or its business overall. For example, during this holiday season, I have ordered basically everything off of Amazon, and I have not done that before. So there are more products coming on Amazon's e-commerce website, and even my family, like my fiance, she has ordered everything off of Amazon this Christmas. So again, I just think that this business is going to be incredible over the longer term. Now, if we take a little bit of a deeper look at its financials right now, we can see that the revenue is sitting at an all-time high right now. In the most recent quarter, it did in fact hit an all-time high. Now, what I also love about Amazon is its operating cash flows have been absolutely skyrocketing. If we zoom in a little bit here, we can see that the operating cash flow is sitting at an all-time high in the trailing 12 months of about $71.7 billion now. This is what I love to see because historically Amazon has been valued in the market off of its operating cash flows. And the reason for that is because Amazon reinvests its operating cash flow back into growth for the business or capital expenditures, so its free cash flows are usually subdued quite significantly, and therefore the market tends to focus on Amazon's operating cash flow as a sign of how much cash the business can actually produce. Now, if we head over to Stock Unlock's freeform tool here, and we go and take a look at Amazon's price to operating cash flow, we can see that it is sitting right around 21 right now. It's actually at about 21.2. Now, historically, the stock bottoms out around 20. It actually got to about 18.8 right here in January of 2023. But other than that, the stock typically likes to bottom out around a price to operating cash flow of around 20. So with the stock trading for a price to operating cash flow of around 21 right now, it is actually still on the lower end of where the stock typically trades. Therefore, personally, I do not think that Amazon is actually that expensive today, and I do think that its operating cash flows are going to continue growing in the future. And I think that the fourth quarter of this year, the company is going to report very strong operating cash flow figures, which is probably going to bring its operating cash flows to an all-time high and bring down the price to operating cash flow even further if the stock does not move up. So in my opinion, I think that Amazon is a hold for me right now. It is not really a stock that I am looking to add to at the moment because the stock is still up 71% year to date. So I think that for now, I'm just going to be holding it, and I'm not really eager to be adding to it, but I don't think that the stock is overly expensive today. Now, moving on to the next stock in the portfolio, this one is Alimentation Couche-Tard, and this is a massive Canadian convenience store business. I own it because I do not think that convenience stores are going to go anywhere, and this business is also expanding into more and more countries around Europe and around the Asia-Pacific region. I really like to see that they are expanding in the Asia-Pacific region, because if you watch my channel, then you know that I am very bullish on that area of the world and its growth over the coming decades. Alimentation is also a serial acquirer. So basically what they do is they acquire new convenience store locations at very cheap prices and then turn them around, get their cash flows increased, and then use that cash flow to go out and buy even more convenience stores. That is how they grow their network. It's the main way that the business actually grows. So as long as the business can continue acquiring convenience stores, then I think that its growth will be significant in the future. And take a look at this, by the way. This stock was worth about 50 cents back in the year 2000, and it is now worth $77 today. If we take a look at a percent change, this is around 15,000% returns over the past 23 years, and the stock is just continuing to make all-time highs. If we take a look at the fundamentals of this business as well, it is just absolutely insane. The revenue actually does have waves where it goes up and down like this, and this is because it is a convenience store and gas station business, right? So as gas prices increase and decrease, it actually sees its revenue go up and down. However, what is interesting about this is if we take a look at its operating cash flows, it is much more consistently growing, and the operating cash flows are sitting at an all-time high right now. And this is interesting to me because the operating cash flows and the profitability of the business seems like it's not actually directly tied to the revenue, because the revenue goes up and down, but the cash flows actually just continue going up. And because of this, I like to value Alimentation Couche-Tard off of its operating cash flow, just like I do with Amazon. So if we take a look at the company's price to operating cash flow right now, and we zoom out to about 2010, we can see that right now the company is trading for a price to operating cash flow of about 11.9, and its average historically has been about 10. So it does look like it is on the higher end of its ranges right now. And in my opinion, I do actually think that the stock is trading a little bit above fair value. And I do think that it is a little bit more on the expensive end. Therefore, I am personally not looking to add to Alimentation Couche-Tard at its current prices, but I would absolutely love to buy more of this stock if it does see any sort of meaningful correction and its price ratios do end up coming down. This is an incredible business with incredible founders and high insider ownership. And I just think that they still have a long runway for future growth. And I would love to own more of this stock if I do see any sort of correction that happens. But at its current price, I'm not too interested in it. Now, moving on to the next stock in the portfolio, this is Alibaba. And I actually haven't talked about Alibaba for quite some time on my channel, but the stock just continues to get freaking hit, okay? I believe that it hit a brand new 52-week low today, so the stock is just continuing to get absolutely pounded. So let's take a look at its financials here really quickly. Let's go over to the income statement, and we can see that the revenue is hitting an all-time high right now, but the revenue hasn't really been growing that strongly since about the third quarter of 2021. So the revenue's kind of been flat for almost 2 years now, or basically 2 years now. If we also take a look at the company's cash flow, we can see that it is not at an all-time high right now. It is coming back up, but again, it is not back at all-time highs. Now, let's go and take a look at this quickly in the freeform tool. And I want to take a look at Alibaba's price to free cash flow here. And we can see that it is now trading for a price to free cash flow of 6.1, which is incredibly, incredibly low. In terms of free cash flow yields, this is now a 16% free cash flow yield. This basically means that if Alibaba wanted to return 100% of its free cash flow to shareholders as a dividend or a stock buyback, then they could use organic cash flows to pay a 16% dividend or buy back 16% of the company's shares on an annual basis. This is a very, very high free cash flow yield, and this is why I continue to hold on to the stock. It's so cheap to the point where I would just feel bad if I were to sell it right now, and I do think that eventually the market sentiment towards China is going to change because it's been significantly negative over the past couple of years, and these businesses will be properly priced against their fundamentals. And in the meantime, I think that it's just going to continue returning a significant amount of cash to its shareholders. In fact, if we take a look at Alibaba's total cash position, we can see that it is $80.2 billion US. And if we take a look at it versus the market cap now, the cash position it's almost half of the company's total market cap. So simply based on its own metrics and price ratios today, I do think that Alibaba is very cheap, and I am happy with my current allocation in the portfolio of about 2.2%. Overall, I do not want too much exposure to Chinese stocks in my portfolio because I feel much more comfortable with North American and European stocks, but I do still want some of that exposure in my portfolio because I do think that it is almost criminally undervalued right now. So I'm not looking to add, I'm just looking to hold, and I will continue to hold my Alibaba position. Now, moving on to the next stock, this is BAM, or Brookfield Asset Management. The stock actually makes up around 11% of the portfolio, and I am currently up 22% on this position, one of the highest gainers in the portfolio right now in terms of total dollar amount. So let's discuss Brookfield Asset Management here really quickly. This is a stock that is currently more on the expensive end as well. The price to earnings ratio here says it is 7.13, but this is because Brookfield Asset Management likes to report its entire 100% ownership of the business. The BAM ticker here that we're looking at actually only owns 25% of Brookfield Asset Management, the overall company. So when we're taking a look at this ratio right here, we actually have to multiply it by 4, which means that it's trading for a price to earnings ratio of around 28 right now, which I do think is on the higher end for this business. Personally, I like this stock when its dividend yield is above 4%. Currently, the dividend yield is at 3.58%. So in my own portfolio, I am not looking to buy more of this stock right now. However, I do think that it is a great long-term hold and will continue to compound over the long term. I believe that they are projecting earnings growth of about 18% annually over the next 5 years, which is very strong earnings growth, but again, I do think that the price today is kind of pricing in that future growth. So if the stock does see some sort of meaningful correction and that dividend yield does get back up to over 4%, then I will be looking to add more to this position. But for the time being, I am simply just holding on to it and I don't see any reason to sell this stock in the portfolio. I also cover Brookfield Asset Management a lot on my channel, so if you want to see my full deep dives on this business, then make sure to go and check out those videos on my channel. Now moving on to the next stock here, this is Brookfield Infrastructure Partners. We can see that I am currently up 32% on this position as well. It's about 5% of the portfolio. Brookfield Infrastructure Partners is another Brookfield subsidiary, and I recently bought this stock because, in my opinion, it got criminally undervalued just like Alibaba was. The stock was selling off massively due to a short report and some fear around how the company reports its cash flows. And the short report basically said that the company is not able to cover its dividend right here with organic cash flows. After diving through the company's financials, I thought that the short report was false and not correct. And therefore, I used that short report as an opportunity to buy this stock when I thought that it was undervalued. Now, if we take a quick look at Brookfield Infrastructure's financials here, we can see that the revenue has been growing very, very nicely over the past decade, if not longer. Also, if we go and take a look at its operating cash flows right here, we can see that the operating cash flows are at an all-time high right now of about 3.66 billion. And they have been growing incredibly well over the past decade as well. Personally, I do believe that Brookfield Infrastructure will be able to continue growing its fundamentals over the long term as well, and the business has grown its dividend by about 8% on an annual basis historically, and they are projecting to continue that growth. Now, when I purchased Brookfield Infrastructure recently, it had an over 7% dividend yield. With its future projected dividend growth of 8% per year, this means that within the next 4 to 5 years, my yield on cost should be above 10%, which I do think is pretty significant. Now, lastly, if we head over to the insider transactions on this business, we can see that insiders absolutely love to buy this business. And the most recent insider transaction was when the stock was selling off and the insiders looked like they were purchasing more shares. I love to see this, and I love to see insiders buying more shares of their businesses when the stock goes down. And I do think that the insiders of this business are very strong, and the management of this company is very strong as well. So that is my opinion on Brookfield Infrastructure right now. I like my allocation of it in the portfolio. I do think that it is selling for more around fair value right now. I don't think that it is undervalued because the stock has corrected again 32% since I bought it. So it's not undervalued anymore, but I'm happy to continue holding it. And I do think that the business will continue to grow over the long term. Now, moving on to the next stock, this is BN, Brookfield Corporation. Again, this is another stock that I have covered massively on my channel. It is the largest position in the portfolio, around 16% now. And the stock is coming back. It's finally coming back, and it is finally starting to add to the actual gains in the portfolio. Because Brookfield has done basically nothing for the past year, however, I have been using this as an opportunity to buy more shares of Brookfield Corporation. Since I own such a large amount of Brookfield Corporation in the portfolio as well, I'm not really looking to grow the position much more. And if you take a look at Brookfield Asset Management of 11%, Brookfield Infrastructure Partners of about 5%, and Brookfield Corporation, this is about 30% of the portfolio exposed to Brookfield right now. I do think that these businesses are very high quality, and Brookfield Corporation here, the BN ticker, I do still believe is undervalued. But let me explain very briefly why I do think that it is still undervalued. The company is selling for roughly 11 times free cash flow, while also projecting to grow its free cash flow by 25% annually over the next 5 years. It's rare to find a business that is selling for 11 times cash flow while also projecting such high cash flow growth. So I do think that there is still a disconnect between the company's fundamentals and its price in the market today, and over the long term, I do expect this to be corrected. Personally, I think the market is undervaluing this business due to its real estate assets and its overall complexity. It is not an easy business to understand and analyze, and again, I do think that is creating a little bit of a discount. So basically, my thoughts on Brookfield Corporation is if I didn't already own so much of it, I would be buying more of it today and dollar cost averaging because I do still think that it is below fair value. Now, moving on to the next stock, this one is Cargojet, and this is one that I don't really talk about that much. But this is an airline business that is solely focused on moving cargo. The business does overnight flights all over Canada to make sure cargo is delivered on time and efficiently. They don't do any passenger airlines at all. They are solely 100% focused on moving goods around the economy. Now, if we take a look at the historical performance of this business, back in 2009, it was a $2.19 stock. And then in November of 2020, it was up 11,100%. So it produced returns of over 100x over those 11 years. However, since then, the stock was in a massive correction of nearly 70%, and it sold all the way down to about $79 per share. But now the stock is rebounding a little bit right here, but overall it was in a massive downtrend for about 2 years from its peak in 2020. The business has been facing some significant headwinds with a overall slowing down economy. If we also take a look at its revenues, we can see that they did top out here in 2022, and they have been coming down over the past couple of quarters. Now, if we go and take a look at the company's operating cash flows, we can also see that they peaked here in the first quarter of 2021, and they have been declining since then. That is probably why the stock has been downtrending as well, is because its overall operating cash flows have been coming down. So let's head over to Stock Unlock's freeform tool once again. And right here, we can see that at its peak, it was selling for a price to operating cash flow of about 19, which I do think was a little bit on the higher end for the business. So in 2020, it looks like the stock got a little bit ahead of itself, because we can see that its average price to operating cash flow over the past 7 years, 8 years-ish, has been around 10. However, we can also see that the stock sold down to a price to operating cash flow here of 6, which is right around the lowest the stock has sold for over the past 8 years. So basically, I think the stock got ahead of itself in 2020, and then I think that it got below itself in 2023 and was actually selling for a very cheap price here in October of 2023. Now the stock is correcting. It is trading for a price to operating cash flow now of 8.3. So right now the stock is still below its historical averages and arguably could be selling below fair value right now as well. I also do think that the long-term trend of e-commerce will be a tailwind for this business and allow it to continue growing through the short-term headwinds that it is currently experiencing. However, I am currently happy with my exposure to this business, so I'm not looking to add more of it. So I am just going to be holding on to it because, again, I do think that there are going to be long-term tailwinds that propel this business forward. So now let's move on to the next business here, which is CP Rail. I recently did a full dedicated video to this business and why I ended up purchasing it. In my opinion, CP has the best rail network in the world, and it is the only company to connect Canada, the US, and Mexico. With more companies nearshoring their manufacturing, which is moving manufacturing from China to Mexico, I think CP stands to benefit greatly. They also recently acquired Kansas City Southern, which expanded their railways and widened the business's moat. I also think trains are going to be around for the next 100 years. They're by far the most efficient way to move goods across the economy, and I do not believe that any new railroad companies are going to be built or be able to compete with the existing ones. Therefore, I think CP will be around and producing cash flow for its shareholders for decades to come, if not centuries to come. It is also the stock that I was most recently adding to, and I would be happy to continue building this position in my portfolio. All right, but let's move on to the next business now, which is Constellation Software. This is an incredible business. Seriously, if you're ever looking for a great case study of a wonderful business, then choose this one and study it. Go read all of the president's letters on their website and take notes. It is an absolute masterclass on investing and knowing what to look for in a business. Constellation is another serial acquirer in the software industry. It acquires and manages software businesses and then uses the cash flow to continue acquiring more and more businesses. The stock is also up roughly 18,000% since becoming public, and it continues rallying hard and hitting all-time highs. If we go and take a quick look at the financials of this business, we can see that the revenue growth is just a thing of beauty. I do not believe that this business has ever reported a quarter where its revenue has declined. Every single quarter, the business continues to see more and more growth, and it has been an absolute compounding machine. If we also go over to the company's cash flow and take a look at their operating cash flows, we can see the exact same thing. This business's operating cash flows over the long term grows ridiculously well, and the cash flows are sitting at an all-time high right now. One other thing that is ridiculous about Constellation Software is it has a gross margin of 98%, and it has maintained a gross margin of above 90% over the past decade. So it's an incredibly profitable business, and it just continues to grow and compound very well. Another really interesting thing about Constellation Software is its shares outstanding have not budged over the past 13 years. The company doesn't issue new shares, and it does not buy back any shares. And one thing that I've heard from investors is they ask the question of why doesn't Constellation use its cash flow to buy back shares? And honestly, this is a fair question. So here is my explanation on why Constellation Software does not buy back shares. And to understand this, we're going to have to head over to Stock Unlock's freeform tool and take a look at the company's historical return on invested capital. So on average, over the past decade, they've had an ROIC, or return on invested capital, of 42%. So what this means is Constellation Software can deploy its cash flows to acquire businesses at an average of 42% return on invested capital. That is a very high return on their cash flow. Since the company has such a ridiculously high ROIC, they actually are better off deploying the capital into acquiring more businesses and investing back in the business than buying back shares. Because if the company were to buy back shares right now at a 3% free cash flow yield, then basically they would only be able to buy back 3% of the company's shares, and that is basically the yield they would get on their cash flow. So by buying back shares, they would get around a 3% yield on the cash flow, whereas investing it back in the business, they get a 40% plus yield on the cash flow. So for the business, they don't buy back any shares because they just want to continue investing in the business and getting that incredibly high ROIC. And by doing so, the stock is up 180x since becoming a public company. The company is just so focused on creating shareholder value and deploying cash where it will actually benefit shareholders the most. And therefore, they do not buy back any shares. So Constellation Software not buying back shares is actually a reflection of the company knowing how to deploy capital instead of not knowing how to do so. Now, discussing the valuation of the business right now, I do not think that it is cheap. Again, it is selling for a free cash flow yield of 3% and a price to free cash flow of 31, which is the higher end for this business. However, if this stock does see a correction or comes down in any way, then I would absolutely love to buy more of it. But for now, I am just holding on to my position and I'm not eager to buy any more at its current price. All right, moving on to the next stock now. This one is Equitable Bank, and Equitable Bank actually just reported its earnings. Now, the reason that I own Equitable Bank is because it is a small cap Canadian digital bank. I think that this company has a long runway for future growth, as it seems to be the only bank in Canada willing to innovate and launch new modern products. It's a bank that innovates like a startup, and I believe that this will be the business's moat, and I believe that its moat will continue to grow. For example, I constantly hear more and more of my friends and family switching over to EQ Bank, then recommending them. I actually have one friend who talks about EQ Bank every single time that I see him, on his own accord. He is not being paid to do this. He just wants more and more people to know about how good the bank is and tries to get everyone to go and sign up for EQ Bank. They have also been growing their customer base incredibly well, with 30% year-over-year growth to more than 400,000 customers. They've also been seeing strong fundamental growth too. In their most recent earnings report, they reported net income is up 37% year-over-year, revenue is at an all-time high, the dividend is up 5% quarter-over-quarter and 21% year-over-year, and it is still trading for an 8 price to earnings ratio, which I do think is undervalued personally, and I would be happy to continue adding to this business, even though it is selling right near its all-time highs of $81 a share right now. I just think that the fundamentals of this business are so strong. I think that it has an awesome management team. It really focuses on creating shareholder value, and I do think that it does have a long runway for future growth. And then lastly, I don't think that it is overpriced at all right now. All right, now let's move on to Fortinet. This is a cybersecurity business, and I believe that this is the only cybersecurity stock that I own in the portfolio. The business has been seeing a lot of weakness in the market, as it is currently facing some headwinds and slower growth projections. However, if we go and take a look at the company's financials, we can see that its revenue is still growing and hitting all-time highs. And when you zoom out, the revenue growth for this business has been absolutely incredible. If we also go and take a look at the company's cash flows and we scroll down here to the free cash flow, we can see that the free cash flow is hitting all-time highs right now, and it has been absolutely exploding. So it's funny when you zoom out to see the business's overall long-term trend of its growth versus how the stock has been selling off due to them projecting some slower growth over the next year. And here we can see that the company is trading for a price to free cash flow of about 19.2 right now, which I do think is quite cheap for a business that is growing so well over the longer terms. We can also see that historically the business's low price to free cash flow was about 16.8 here in 2018. So it does look like it is trading on the lower end of its price to free cash flow range. And its historical price to free cash flow average over the past decade has been about 27. And again, it is trading for 19.3 right now. So it is selling well below historical averages as well. The company also has very high insider ownership, and it is founder led. I also think that there is a long runway for future growth in the cybersecurity industry, so I do think that the headwinds that the company is currently facing will go away, and over the long term, I do think that tailwinds will propel this business forward. I also think that it is selling for a very reasonable price today. I mean, 19 times cash flow is an over 5% free cash flow yield for a business that is growing incredibly well at double-digit growth rates. So I do think that the business is actually undervalued right now, and it is one that I would be happy to dollar cost average. I'm also happy with my exposure to it, and I do believe it is one of the stocks that is on the cheaper end today. All right, now let's move on to Google. Everyone knows Google. The stock has also been performing well over the last week due to the Gemini AI release. I think that this is a stock that I want to just hold on to forever unless it becomes insanely overvalued. Like if it went to a 50 times cash flow tomorrow, I would end up selling my position. But currently the stock is trading for 21 times cash flow. I think that is probably around fair value for the business. So I'm not really eager to continue adding to this one. I'm not excited to continue adding to it, but I do just want to hold on to it over the long term. When Google was under $100 a share, I thought that it was undervalued and an obvious buy. But again, now that the stock is closer to fair value or selling above fair value, I am just going to be holding on to it. All right, moving on to the next stock. This one is Goeasy here. This is a small cap Canadian lender that has been absolutely crushing it. If we take a quick look at the company's revenue, you can see just how awesomely it has been compounding over the long term. And the revenue is sitting at an all-time high right now, and the company is growing at something like 20% per year right now, even despite all of the macroeconomic headwinds that we are currently seeing. If we take a look at this business's price to earnings ratio, it is currently selling for about 11.7. Its average price to earnings ratio over the past decade has been about 12.3, so it is selling near its historical averages or slightly below historical averages. Personally, I do think that this business is selling for fair value now, so I'm not eager to continue adding to this one, but this is a stock that I was adding to and buying while it was near $100 a share. Now the stock is selling for 52-week highs. It is no longer in that big correction that it saw right here. And now, again, I do think that it is selling for fair value, and that is why I am not really eager to continue adding to it, but I am very happy with this position. I'm very happy with the fundamentals, and I do think that this business will continue to grow over the longer term. All right, now let's move on to HDB. This is India's largest bank, and I own it because India's economy is growing rapidly. And with India's overall economic growth, I think that HDB will continue to grow over the longer term. HDB is also continuing to take up more and more market share of India's banking sector. However, over the past 5 years, the stock hasn't really been performing that well. And recently, the stock was basically flat on a 5-year timeline. However, if we take a look at the fundamentals of this business, we can see that its yearly revenue growth has been absolutely exploding, along with its yearly net income. So the business has been continuing to grow and compound its overall fundamentals as the stock price hasn't really been doing anything. HDB also recently did a massive acquisition, which is currently harming its earnings per share due to the acquisition costs. But on an adjusted basis, I believe that the business is now selling for around 16 times earnings, which is very low for the business historically. It usually trades around 20 times earnings, so I think that right now the stock is actually a little bit undervalued relative to its historical averages and how much growth potential it has with the growth of India's overall economy. This is a stock that I want to hold for the long term, and honestly, it's one that I don't really ever think about because I think that as India's economy grows for the decades to come, HDB will grow along with it, and it's kind of just one of those stocks that I want to hold for the long term. And I don't really ever think about it, it's just one of those stocks. So I am happy with my position in this one, and I'm not currently looking to grow it. However, again, I do think that the stock is slightly undervalued. So if I didn't already own it, then I would be dollar cost averaging it or buying it in my portfolio. Now, the last 2 stocks in the portfolio here are Lumine and Topicus. Both of these stocks are spin-offs from Constellation Software, and they both have the exact same business model as Constellation Software, where they acquire and own software businesses. So they basically acquire software companies, fix them up, increase the cash flow, then use that cash flow to continue going out and acquiring more businesses. In this video, I already discussed how high quality Constellation Software's business is, and these businesses, Lumine and Topicus, are basically just subsidiaries of Constellation Software. So if they can even become half the business that Constellation Software is, then I will be incredibly happy with these 2 companies over the longer term. Now, in terms of adding more to these positions, I'm not currently looking to add more to Lumine because the stock has been performing incredibly well over the past couple of months. You can see that I am currently up 38% on that position. However, Topicus, I am not up nearly as much on. And if I had to choose between these 2 businesses right now, I would personally be adding more to Topicus because it is selling for closer to fair value, at least in my own opinion. It's also a smaller position in the portfolio at 3.5% versus Lumine being about 6%. So I'd be more happy to increase my position in Topicus versus Lumine right now. But that is the overall portfolio update. Those are all of the positions that I own right now, my thoughts on them, why I own them, and my thoughts on their valuations today. Again, the overall portfolio is hitting new all-time highs, and it is up 37% since its inception. It's outperforming the S&P 500 now by about 15%. So I am very happy with the portfolio performance. And overall, I do think that the businesses in the portfolio are all extremely high quality and will continue to compound over the longer term. And I think that this is going to be a very long video. So if you made it to the end, then thank you so much for watching. I truly do appreciate it. And if you did enjoy the video, then please remember to leave a like on it. And if you're by chance you're new here and you want to see more stock market related content like this and follow the portfolio's progression over time to see if I can continue to outperform the S&P 500, then please consider subscribing to the channel as well. But that is going to wrap up the video for today, everyone. So thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in my next one.